Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 249 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets. And this week, Matt is out again, and Nick Whitaker is back on the show filling in for him. So it's good to have you back, Nick. I know Aaron has filled in the past couple times Matt has been out. So it's been about a month and a half since you've been on.
Yeah, I was gonna say I've taken a brief hiatus, so it's good to be back.
You have. Kind of a lot's happened since you've been gone, or at least not on the show in terms of markets. So last time you were on, things were looking nice and rosy. Stocks were still in a very strong uptrend, and here we are a month and a half later, and some people feel like the world is gonna fall apart. But we'll get to that here in a little bit. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on April 24th. S&P 500 index is down 3.5% for the month, but still up 6.3% for the year. The Dow Jones Industrial Average down 3.4% for the month and up 2% for the year. The NASDAQ Composite Index down 4.1% for the month and up 4.7% for the year. The Russell 2000 Small Cap Index is down 6% for the month and down 1.5% for the year. And the Vanguard All World Ex United States ETF down 2.3% for the month and up 2.1% for the year. 3-month Treasury rate at 5.46%, the 2-year Treasury rate 4.89%, and the 10-year Treasury rate at 4.65%. Moving on to big headlines and current events from this week. Obviously, we are in the middle of peak earnings season. So Netflix has already reported. I'm not sure if Facebook or Meta has reported yet, but I know Amazon is set to report next week or this week. But anyways, we're going to see nearly 40% of the S&P have reported their Q1 2024 earnings by the end of this week. So it seems like on the outset, Nick, earnings has been pretty good so far, and people might be saying, well, why is the market selling off then? And again, I think the easy answer is just a lot of this positive earnings news has been priced into these stocks over the past several months. So that's the easy response in my opinion. CPI data comes out on Friday, so investors will be keeping an eye on that. And last but not least, just the pullback in stocks has continued a little bit. We've had some strong days so far this week. We are recording this on April 25th, which is a Thursday morning, so the market hasn't opened up yet. But again, just to reiterate, Nick, I think that this pullback has come in a good time, and I'm actually welcoming it because if things ran much further or kept going on for the next 4 or 5 months without a pullback like this, then it would just make the eventual pullback a lot more painful. So I think it's a good thing this is happening right now, so we should embrace it. Again, it was only like a 5.5%, maybe 6% pullback from the peak to trough. And we could still have more, right? I mean, as we continue to have a lot of these larger weights in the S&P 500 report earnings, that could have a big effect on either direction on what happens with the S&P 500 over the next week, 2 weeks. But for right now, things seem like the pullback has kind of run its course. And I'll have some more information on that for listeners here in a bit.
Yeah, all well said. I agree with that. I think you and I were on the podcast probably, a couple months ago talking about expecting a pullback and not being surprised if we saw that earlier in the year, like February. So I think for a lot of market participants, I think it is welcome. You want to see a little bit of profit taking. You want to see the markets behaving normally. Yeah, I would echo all of the comments that you just mentioned.
Yeah. Well, the first thing I have for listeners this week, Nick, is a chart from Y Charts that I had created, just looking at mortgage rates. So Jenna will throw this up on the YouTube page. This will also be on our show notes. It just shows the 15-year mortgage rate and 30-year mortgage rate simply, right? And it's no secret that, in 2021, interest rates really started rising very rapidly. And we went from an average 30-year mortgage rate of, 2.5% now up to, over 7%. And I just wanted to give an update on this because I know there are several people out there, looking for homes or waiting for a good time to buy a home. And this is a huge deterrent, right? It's the highest, rates that we've seen in quite some time, going back to, 2004, 2005, 2006. And I think if inflation continues to stay hot, this is not going down anytime soon. And I think if the Fed continues to delay interest rate cuts, mortgage rates are going to stay elevated. And that's kind of just the situation that we're in right now. Eventually mortgage rates will come down. And I'm sure, kind of like 2020, 2019, there was a mass rush to refinance rates, right? Because rates were so low. And that opportunity will come again, but just no one knows when. And if people are telling you when that's going to happen, I would turn around and run in the other direction because you can't predict this stuff, right? So it's unfortunate that it's kind of pricing some people, especially first-time home buyers, out of the market. But right now, just with the way interest rates are, it kind of seems like that rates are going to stay elevated or kind of hover around this 6 to 7% range, unfortunately.
Yeah. Um, yeah, if anyone's telling listeners out there with 100% confidence what's going to happen with the rates, yeah, I couldn't agree more. Look, turn around and run the other way, because there's a lot of sharp people that were predicting what 5, 6, or 8 cuts this year, and that's obviously changed drastically just in the first 4 months now. So I just pulled up the Fed futures while you were talking there, and 40% of the market sees only one cut by the end of the year.
Right, which is
Only
down
one
from
cut.
6
Uh,
at the beginning of the year.
yeah, yeah. So,
Yeah. And I don't know. I'm kind of torn on the subject because I think if you're gonna be in this property or this house for a long period of time, if you get a 30-year mortgage, there are most likely going to be opportunities to refinance. So if you come
yeah,
across a house that you really like that really fits your family, I'm kind of on one end saying maybe you should just go for it. I know that
yeah,
money's not everything. Money's super important, and how expensive things are from a month to month basis, like a mortgage, is very important. But you also got to think about your lifestyle and your family situation. And if you're in a, 900 square foot apartment and you have 2 kids and one on the way, it's like, well,
yeah.
I know interest rates are high, but will it, increase your level of happiness if you do have more space in a house, right? And that's a decision that everyone has to make. And unfortunately, interest rates are deterring people from making that decision. But I think a lot of times it makes sense just, we understand that mortgage rates are high, but we'll refinance when that time comes.
hmm Yeah, just make sure you don't get too far over your skis with your budget. Maybe you're planning, 30%, or maybe 30% for the mortgage, and maybe push that up to 35 and hope in a couple of years you can refinance it down and get the mortgage payment reasonable.
Yeah.
With the mortgage rate so high, and it seems like home prices. I was actually just looking at the Dayton area. yesterday on my phone because I noticed there's a lot of homes in my neighborhood that are for sale, and I'm like, oh wow, that's interesting. So I was looking at that yesterday, and it seems like the prices haven't fallen off a ton. Slowed down a little bit, but just like regionally in our area here. So that's going to drastically impact your purchasing power as a consumer. So it really does get down to those budgeting numbers, and maybe you have to push it up a little bit. I did that with my first purchase back in 2019, I think it was. So where the market's just more expensive than I was expecting, and it's like, guess we're gonna have to bump up the budget a little bit. So
Right.
um, it happens.
Yeah.
That's how the market fluctuates.
Second thing I had was a blog post from Ryan Dietrich with Carson Investment Research. This was back on April 16th. He says, now could be a good time to remind investors that volatility is the toll we pay to invest, meaning that we all want the gains, but sometimes you have some pain along the way. Or to quote Ben Franklin, there are no gains without some pains. Here's a great table that we've shared before on volatility in most years. The average year has more than 7 3% dips a year, more than 3 5% mild corrections a year, and a 10% correction a year on average. After yesterday, we've officially had our first 3% dip. That's it. 3% dip, and your average year tends to see more than 7. That should put in perspective just how calm things have been lately. So, as you can see, you can kind of see that in this chart here. And we've talked about over the past couple of months how calm things have been over the past 5 months since the bottom of the market in October,
Hmm.
which has been very nice because we haven't had a whole lot of calm or low volatility investment environment for quite some time.
Yeah, in the past
Um,
couple of years.
so eventually this is going to change, but again, I think it's just good to put it in perspective that the odds say that even if this correction is over, which, as the time of writing was a 3% correction when Ryan was putting this piece together, now it was, it got to a 5% correction and a little more than that. The odds say that some point later this year, we're going to have another 3%, a couple more 3% dips, a couple more 5% dips, probably a 10% correction at some point from the highs. So it's just helpful to share this information so that clients and investors can expect this coming. Because not everyone does what we do from day to day, Nick, and not everyone studies this stuff or completely understands this stuff. But
Yeah.
as much as we can get this out there to the general public, I think it'll prevent a lot of emotional decisions. It'll keep people in check from an emotional standpoint, right? So it's
Yeah.
like, odds are the market's going to sell off prior to the election. So you have market selling off
Yeah.
coming up with a presidential election, which everyone and their mother is saying this is the worst it's been in, since history. We have two people that are incompetent, blah, 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 blah. That could force a lot of people to say, hey, screw this, man. I'm done with the stock market. I'm not risking my money
Hmm.
during a time like this. Um, where, as if you look at the data and you talk about things like what we're talking about right now, it's actually probably very normal for us to have a larger pullback sometime late summer, early fall before the election. It just happens to be right around the election time, right?
Yeah.
Um, just thought that this was interesting. Ryan and his team at Carson always put out really good graphics like this. So if you're just listening to this, I would encourage you to go read this full article from Ryan or look at the chart, which both of those are in our show notes.
Yeah,
Um,
that's a great point. I was just gonna say for listeners, it wouldn't shock me if we see that 10% correction sooner than later.
mhm,
That's kind of what I've been expecting for the past couple months, and it's just been delayed, delayed, delayed. Just because we've run so far from October. So just food for thought. I mean,
yeah,
you know, to hang in there. It's all right. The corrections are normal, and like you say all the time, healthy. We like to see it.
yeah. Last thing I had was an article written by Melanie Waddle on ThinkAdvisor titled T+1 starts in May. Are you ready? And I know this is something that me and you, Nick, are very excited about, but
Oh,
probably
yes.
something the general public isn't really aware of, I should say.
Yeah.
So she says on May 28th, the new standard for trade settlement will become the next business day after a trade, or T+1. As it stands now, the settlement date occurs 2 business days after the trade date, T+2. As FINRA explains, the trade date is the day an order to buy or sell a security is executed. The settlement date is the day the order is finalized on which funds and the securities are available. The move to T+1 reflects improvements in technology that allows trades to settle more quickly. With most trading and banking activity occurring online, extra days to physically deliver securities or funds are no longer needed. These include transactions for stocks, bonds, municipal securities, exchange traded funds, certain mutual funds, and limited partnerships that trade on an exchange. So, why is this important for anyone that has money invested in the market, right? It changes the amount of time until a security is sold until that money hits your bank account, right? So, for example, if we have a client calls us on a Monday, they're like, hey, I need money before the end of the day, right? To a certain extent, we could be handcuffed depending on which securities they hold in the account. But if they only have securities that um, can be sold and you know according to this T+2 settlement, then the earliest we can get you the money is Wednesday. And a lot of times that doesn't
Yeah.
work for people because things come up, they need money, et cetera, et cetera. This is going to be great because it just shrinks that time. So if you call me on a Monday, you need money on a Tuesday, that's not going to be an issue. We can place a trade on Monday, send you the money on Tuesday. Because right now, we would have to wait 2 days until Wednesday in this example to send you that money. So it just speeds up the process. I've been wondering why they haven't changed this for quite some time now. So it's nice to see that we are keeping up with the times and speeding this process up, because I think something that's really important to people when they have a situation like this, but they're not necessarily thinking about it when they're investing their money, is liquidity and the access they have to these funds. And don't get me wrong, placing a trade on a Monday and getting the money on a Wednesday is still very liquid, right?
Yeah,
But
extremely liquid
but
in the
but,
grand
but
scheme of
life
things.
life happens, things come up. A lot of times people don't keep a lot of money in their checking and savings account, and they need access to funds quickly, and this is going to help with that. So yeah, I think that this is moving in the right direction, and hopefully one day we can get to trade date and settlement date is instantaneous and right away. But for right now, this is a step in the right direction, in my opinion.
Yeah, I actually read an kind of in-depth article about the history of this yesterday. Um, and because it used to be T+5 back when you actually had to deliver the physical certificates, and then that's what led to the creation of clearinghouses, where they could just keep all the physical certificates in one spot, and then they just had a ledger, and then that brought it down to T+2. Um,
Sure, a lot of younger
it's
people don't even know what stock certificates are.
Yeah, yeah, yeah. I think I've seen a couple, but yeah, it was just back in the day when you would buy a stock, you'd get a piece of paper that was your stock. So, if you've watched any like old, 1800s kind of westerns, you'll hear them talk about like stock certificates sometimes, with the railroads, Manifest Destiny, all that. Um, but the one kind of caveat to why there was T+2 that I learned had to do with just the amount of money that goes on. Think institutional trading, bulge bracket banks, and how much money is moving on a day-to-day basis. Um, Crazy amounts of trading volumes, et cetera. The T+2 just gives them extra time to kind of clean up their trades if there was a mistake that happened, and it gives like the big banks extra time. The other big piece of it is more on the international side with currency trading, and being able to like switch your currencies because you need 2 days to flip your currencies. for a trade. So that is probably going to be the biggest impact to the markets, is going to actually be in international investors, and being able to, if you're trying to buy a US stock in US dollars, flipping from the yen, your bank's going to have to figure out how to accommodate that. And, maybe they're going to have to hold more dollars on hand so that they can get you into your trade quicker. So that's probably the biggest impact to this is the currency situation from what I've read. But there's been some pushback from the bulge bracket banks, because you can imagine how much money is moving around in the system, and they've been used to doing it this way, and corrections are going to have to happen. Or, hey, oh wow, we need $500,000 and or whatever. I mean, $500 million, and they're going to have to move money around to make sure the cash isn't in debit, et cetera, et cetera. So they don't have to file trade extensions. So there'll be a lot of pain for for certain industries, but it's not going to impact the consumer, unfortunately. Be very interested to talk to my old colleagues in the stock surveillance world, because this is a huge deal in the stock surveillance world. So
Right.
yeah, it's, interesting times.
Yeah, it is for sure. But that's all I had, so I will turn it over to you.
Yeah, the first thing I had, we've mentioned earnings, so this is just an update on earnings to date. So the earnings that have been released thus far. It's a tweet from Matt Miskin. He's co-chief of investment strategist at John Hancock Investments. He says the following: S&P 500 earnings growth thus far plus 3.7%. Still have a long way to go, but not bad. He says still have a long way to go, and a lot of people to report earnings. That's what he means by that. MSCI EAFE earnings growth reported at minus 3.7%, and emerging markets at plus 5.3. So I think international, Europe, Asia is at minus 3.7, and emerging markets is emerging markets, right? He put a little chart together here, which we'll share and let you guys look at it. The one caveat, I'll kind of walk you through the columns here. The first column is percent of COS, that's companies, percent of companies reported. So you can see that across the different sectors. The growth blended percentage, what that means is that's taking the actual numbers that have been reported plus expectations, so plus estimates across the whole market, and it's kind of blending those together. So definitely take that with a grain of salt, because people miss on their earnings estimates all the time. That's very normal. Or, surprise to the upside, surprise to the downside, et cetera. And then you can see the actual growth reported across thus far we have 24% of S&P is reported. You can see the growth numbers across there. And surprise, surprise, look where the growth is highest.
Technology.
Information technology, right? So this is a great chart to just kind of show you, this is why there's so much concentration in the Magnificent Seven and information technology, and why they get so much headline news, et cetera. It's because of the earnings growth.
Yeah, and
And then,
really, and I think this is not to cut you off, Nick,
no,
but
go ahead.
I think this is a good opportunity because it, I don't think a lot of people understand why it's like, okay, a company's like growing faster, that's fine, but why is it outperforming so much? I guess just think about it. If you were to, if you were to own part of a business, and a lot of people do with owning stock in these publicly traded companies, the valuation or the worth of the business is a lot more if they're growing their earnings and they're making more money, right? So this is really simplistic, right? So
Mhm.
do you want to be a part of a business that is making more money or making less money, right? I think most people would be like,
Yeah,
I want to be a part of a business that's making more money, because that means my ownership is highly valued. So when I go to sell it to somebody else, people are going to pay me more for that, right?
yeah,
So
exactly.
that's why, earnings and revenue growth really do drive stock prices, because people want to be participating in companies that are growing. And I think that's just a really simplistic way to to put it to people.
Yeah. flip it on the other side, right? Like a mature company, like a massive, like consumer staple company. I don't want to pick on any individual companies, but I'm sure if you come to mind that are, very mature companies have been around for a long time and they're not growing as much. They're paying a little bit of a dividend, but it's like if you were invested in a company like that, whatever you buy at that price, it's probably not going to go up too much. It'll go down a little maybe. So whenever you have to turn around and sell it, it's, it's not going to be as much,
Yeah.
simplistically speaking. If you break it
Yeah.
down to like that, there's great stuff on YouTube if people ever want to like really dig into, analyzing companies. I think Bill Ackman does like a lemonade stand kind of thing.
Hmm.
So anyway, yeah. So yeah, take a look at this chart. Hopefully that helps you understand kind of where the market is right now. Again, another 40% of S&P companies are going to report by the end of this week. So these numbers are of course going to change drastically. But thus far, it's a pretty good start. Um, and I've actually been pretty pleased with some of the reactions to earnings. I was kind of expecting a lot of what we call sell the news, and we've seen a little bit of that, but not as much as I was expecting. We've seen a little bit more buying tip on some of the underbought names, which is nice. I expect we'll really understand the sell the news once we get through. I would say the semiconductor chips, which will be later in the next month.
Can you just take a second and what do you mean by that? Sell the news.
Yeah, sell the news is basically uh, let's take the chip space, for example. Semiconductor chips have done really well over the past 6 months. So a sell the news trade would be, let's say they come out and their earnings are phenomenal and they beat all estimates and everything's rosy and they guide higher or they guide in line with expectations. So their guidance for the following quarter is in line with expectations, and the stock, pulls back and sells. So that's a sell the news trade, and it's basically just it's a profit taking move where
Or
it's like, okay, everything's rosy, but this has run too much. We need to profit take, and I think one of the reasons we were expecting some of the sell the news trade is because, again, going back to what we talked about earlier, think how much the market's run since October. We're looking for that pullback. It's like, certain areas in the market have really done very well, semiconductors being one of those. So that's a space that I could definitely see a sell the news kind of trade. But in other areas where I was expecting to see it, I've not seen it. So time will tell.
yeah, thank you.
Uh, uh-huh. The second thing I had is just a quick look at market reversion. So we talked a little bit about the market pulling back. This is just an internal chart. It's using Y charts data. There are 3 bars here. It's broken out across the sectors, different sectors in the market. The first bar is year end to the 1st of April, and that's kind of the inflection point when the market started to pull back a little bit. The second bar is from that inflection point to the end of the year, or well, I should say the end of the year, sorry, to the end of our data set here, which is the 23rd. And then the third bar is just year to date, right? So it's kind of taking both of those and looking at year to date. So I just wanted to show people the reversion from the beginning of the year of kind of like, hey, what's gone up to that high point, and then at that high point, what happened, and then big picture, what's going on. So the dark bar is the big picture, and you can see, energy just kept on trucking, even when, for example, when the market was pulling back, energy just kept doing pretty well, which is great. Tech, you see that reversion trade, right? So there's that profit taking, sell the news a little bit, right? Healthcare, real estate's been very poor throughout the year. And the consumer cyclical trade has been turned around. Right, it was a little soft, a little bit of an underperformer to start the year, and then that reversion trade in the consumer cyclical got hit pretty hard. So I think um, kind of your consumer demand stocks. So, do you have any thoughts about this? Anything to add?
No, not really. I will say that, real estate is a little surprising to me, but it isn't. I mean, obviously with rates higher and people able to, invest in, a quote unquote risk-free rate of return of almost 5% from the US government, they're like, well, if real estate's paying me a dividend or 5 or 6% and it's higher risk, why would I even consider that? Right. So it does not surprise me from that standpoint. But then the flip side is usually during presidential election years, I'm going to talk about seasonality again, real estate tends to do really good in Q2, and especially in April and May, but we're not seeing that obviously, right? So I think it would probably take a significant earnings turnaround for real estate for that, you know, sector to get out of the bottom of the barrel.
Yeah.
But it's not too surprising to me, right? And like you mentioned earlier, the growth in earnings is really in technology right now, by leaps and bounds, right? So it wouldn't
Mhm.
surprise me if tech had a little bit of a pullback right now, but then kind of resumes its uptrend in the next couple of months.
Mhm. Absolutely. Yeah, I think the real estate trade is probably, I think there's probably a bit of a sentiment overhang in that space right now with the commercial real estate concerns. I think you have that. I think you have a lot of international commercial real estate exposure to U.S. markets, so international investors with exposure to U.S. Commercial, and there's a lot of negative headlines, and China's has issues with their commercial real estate. So I think that's probably weighing on a number of sectors. And then you take that with the high rates, it's going to affect multifamily, and then it's other areas of the market as well. Then you take a big like industrial REITs, for example, those are going to hit a little bit more with like the consumer and like industrial, like the cyclical trade a little bit more. So it makes sense, but I would probably chalk it up to the sentiment overhang a little bit there.
So moving on to our financial planning topic of the week, Taylor Ledbetter at our office has joined us again to talk about some mistakes that you might be making, some common mistakes that you might be making from an article that she wants to share with the listeners.
Yeah, so this article, it's going to be from Kiplinger's website, and it's from their advisor collection. And a lot of these points I'm going to go over today are all pretty basic, but they're very important. So the first one I know we've talked about a lot on the podcast, and it is reacting emotionally to market fluctuations. So the article goes on to say, when it comes to building wealth, many investors make the mistake of reacting emotionally to the market. They tend to sell off investments during a downturn out of fear or invest heavily in a hot sector without sufficient research. Emotional decisions can lead to buying high and selling low, the opposite of a sound investment strategy. And I think this is really important because some of the best trading days can happen during some of those really bad years. And obviously, you can't really time that, or it's very difficult to time. So it's just best to stay, fully invested as much as possible.
Yeah, and I've seen charts before, Taylor, and we might have even shared those on this show before. Is that if you miss, the top 5 trading days of each year, it actually does significant damage to long-term total returns. So it is important to kind of, to a certain extent, sit through those corrections and at least have exposure to the market. Because if you miss those, top 5 or 10 trading days each year, returns are highly impacted in a negative way.
hmm Yeah, and I know like one example, 2008, that year definitely sticks out in a lot of investors' minds. Um, but like October 13th, for example, that day in '08 was up 11.6%. And there were a couple days in October like that.
Yeah.
So yeah, but like you said, it does really impact the long-term growth of the account.
hmm And then you're kicking yourself on the other side of it, right? So if you have a day where the market's up, 5% or 4% the next day, and the day before you sold everything, you're like, oh my gosh. And let me tell you, I know from experience that feeling is a lot worse, you know.
Hmm.
So and we saw that in 2020 during COVID. You had days where the market was down 4%, up 5%, down 3%, up, you know, 3.5%. So it was wild swings, but yeah, you would have missed some pretty good days.
Hmm. Yeah, and I think more so too, we just don't want somebody to maybe sell everything or go to cash or put half of their account in cash. Like it's okay to rebalance and maybe do some sector rotations.
Hmm.
But so I think we're just referring to, selling everything.
For sure.
The next point is neglecting to balance safe and risky investments. So, sometimes I will see younger people's accounts and they might be like way too conservative too early. And on the flip side, with older people, they might be way too aggressive or way too conservative. I mean, you have to find that happy medium and everybody is so different too with their risk tolerance and what they're comfortable with.
Yeah, nothing to add there.
Yeah, I think that you can, for the most part, stay fairly aggressive in your accounts most of your working life. I don't really see a need to, add bonds or fixed income to the accounts early on.
Right. Yeah. I mean, if history, or excuse me, if the future plays anything out like the past, then I would say that is prudent advice.
Hmm. Yeah, and definitely more of a psychological factor with that.
Right.
The next one is pretty simple. It's just failing to contribute to a retirement account. So I think that, pretty much speaks for itself because you don't want to rely on only Social Security for income when you retire. And, even if you do have a 401k through work or just any type of plan through work, it's still good to save on the side, maybe open up an IRA through, just separate from your employer.
So yeah, it's not even from like a retirement standpoint too. It's, especially if you make less than a certain amount of money, Taylor, and you're not contributing to a pre-tax IRA, for example, you're not taking advantage of those tax benefits now, right? So it's not
Hmm.
only missing out on contributing to your retirement, it's taking advantage of lowering your tax bill right now.
Hmm. Yeah, and typically through your employer, there's only one type of account they have, and it is good to have maybe different tax buckets for retirement because you can manipulate your bracket a little bit with your income. So I think it's best to have, multiple options to pull from because,
Yeah.
each type of account, there's different advantages and disadvantages. The next point the article goes over is failing to build a solid financial foundation. So, making sure you know how to manage your money well. They say it's counterproductive if you're, overspending, paying high interest on debt, don't have an emergency fund. And, this point, it is just so basic, but I think it really highlights that there's not enough importance put on learning these basic concepts because it's these small decisions over time that really can make the biggest impact.
Yeah, for sure. And, interest on debt, for example, is one of them that at least I was never taught in school growing up. I don't know about you, Taylor, but I was never taught how to do a budget. I was never taught how interest works, never taught about how debt works. And especially, in this day and age, once you turn 18 and, you go to college or you start working and you're starting to get off your parents' payroll, you put things on credit cards, right? And you need
Mhm.
to learn how credit cards work. I remember I had several friends in college that, they would rack up credit card bills and they would just be paying the monthly minimum each month. And they didn't understand how the 22% interest rate works on credit cards. So it can come down to things as simple as that to make a huge difference.
Oh yeah, definitely. And like another kind of just adding on to the example you just gave, something that I see a lot too is, like younger people, maybe when they switch jobs, instead of rolling over their old 401k to their new employer, they might cash it out, pay those
Hmm.
taxes and
Right.
pay that penalty just because it's a quote unquote smaller account, but that's also their biggest advantage when you're a lot younger.
Yeah, 100%.
Mhm. Um, the next concept is just misunderstanding the concept of buying low and selling high. Um, I think that ties into the first point we kind of talked about, which was reacting emotionally to the market and those fluctuations. So, yeah, it's just really about being disciplined enough to follow that type of strategy and, just psychologically not letting that affect you.
Yeah.
The next point is neglecting to identify your wealth building savings rates. So the article says people often make the mistake of not identifying their savings rate. Questions around your well being help you identify the amount that will make you feel secure and fulfill you enough to create an aspirational life. So this is just referring to, how much you're saving into any type of account you have, and if that savings rate is going to allow you to maintain your lifestyle in retirement, spend more, spend less, because obviously everybody's expense needs are completely different when they retire.
Yeah, and this is something that's different for everyone, and it's a very common question that we get in our industry is, how much should I be saving to my 401k and my IRA and my after-tax brokerage account? And my answer most of the time is it depends. It's like, okay, are you, struggling from week to week and month to month, to meet make ends meet? And if the question is no, it's like, okay, well, if you're comfortable, then you can probably bump up that savings rate. But, vice versa, if you are struggling from week to week, then maybe it makes sense to lower that savings rate,
Hmm.
at least until you can get a raise or find a new higher paying job or something like that. Because it's a balance, in my opinion, between enjoying life now and having discretionary income to spend now versus still saving for retirement to be able to live the way you want to live when you're no longer working. So it is
Hmm.
a balancing act. I don't and I think this is one of those things where people are usually on two ends of the spectrum. Everyone's like, you shouldn't spend a dime, you should save everything you have. And then on the other side, it's no, you have to enjoy life now. Don't worry about saving, just spend, spend, spend. And I think
Hmm.
for most people, it's somewhere in the middle. So it really, unfortunately, it's a frustrating answer, but it really does depend on your situation.
Hmm. Yeah, I mean, because like you said, we would never want somebody to overextend themselves if, monthly they can't really afford to contribute a high amount. But I don't think it's as important. Like if you're just starting out in a job, pick whatever percentage you want to contribute. I think that's kind of less important, but what's more important is increasing that over time. If you start out maybe contributing 5% to an account, don't stay at 5% for 10, 15 years.
Yeah,
Yeah.
totally
So our
agree.
yeah, our general rule of thumb is maybe bump it up once a year or like you said, every time you get a raise.
Mhm.
The last point this article goes over is mixing up short-term savings and long-term investing. So it says people need to balance the need for short-term liquidity with their long-term growth. Investors may not realize they will experience short-term market fluctuations with their long-term investments. Time in the market is more important than trying to time the market.
Yeah,
And
it's great.
yeah.
I think look, and me and Nick talked about this a little bit, um, 10, 15 minutes ago, is when people invest, they're not always thinking about the liquidity of it. So when I say liquidity is how quickly can you turn a financial investment into cash? And private equity or private real estate, a lot of that stuff you can only get your money out 4 times a year, twice per year, once per year, or you're locked up for 5 years, right? And you just need to know
Mhm.
that going into it, that hey, this money that's supposed to be in my savings account should not go into a fund where I can't access it for 5 years, right?
Mhm.
And again, I think it goes back to the educational piece that we discussed a few minutes ago.
Mhm. Yeah, I mean, because saving for the short term or, the emergency fund, money in a savings account, that's a completely different goal than saving for retirement. And I think sometimes for people, it's maybe easy to forget that and keep them separate. Because, if you don't have a lot of liquidity at the bank, and if something happens, you don't want to pull from a retirement account because then you're neglecting, both of those goals. So, it's important to just have a good balance and your mind, keep them separate from each other.
Yeah. Yeah. Well, thanks for joining us again, Taylor, for the financial planning topic of the week. Before we sign off, just wanted to let everybody know, if you want to create your own podcast, use the promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month free with promo code Jessup Wealth. All lower cases, no spaces. Thanks everyone for joining us on episode 249 of the Independent Advisors Podcast. We will be back with you next week for episode 250 with a special guest.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.